This presentation is about expansionary monetary policy. Monetary policy involves the control of the bank rate and the control of money supply. It's mainly the bank rate that we focus on because that's the main thing that affects the economy with respect to monetary policy. Now, we've already seen that we fear accelerating inflation, but the fact is that we fear low inflation as well. So if inflation is at a very low level, for example 0.5%, people uneducated in macroeconomics may feel that that's a good thing because that means prices are rising very slowly. But in fact, what it indicates is that aggregate demand is rising very weakly. It's a sign of weakly rising aggregate demand. Now, of course, we need aggregate demand to be rising in order to fuel economic growth. So if aggregate demand is weak, this is a dangerous sign for future economic growth. And if aggregate demand slows down too much, there is an even bigger danger, which is the danger that low inflation will turn to deflation. So instead of prices going up very slowly, deflation is a situation where prices actually start to fall. So if we go into a shop in an economy which is experiencing deflation, we may see that a bottle of mineral water on the 1st of January costs €2, and then we come back on the 31st of December after a year of deflation, and we see that that same bottle of mineral water is on sale for €1.80. So this is deflation when prices actually fall over a period of time. We can also call deflation negative inflation. It means exactly the same thing. Now, why is this dangerous? The reason this is dangerous is that if deflation is actually seen in an economy, then households defer purchases. What does that mean? It means that they wait before buying. If they feel that goods are going to become cheaper over time, then naturally they will wait before buying. This is very dangerous because this means that aggregate demand, the desire to consume, falls as households choose to wait. And with falling aggregate demand, prices fall even faster, and output starts to fall. And as output starts to fall, unemployment starts to increase. So what we have is called a deflationary spiral. A deflationary spiral, which is a spiral of falling output and rising unemployment. So deflation is almost as bad, in fact it is as bad, as rapidly accelerating inflation. So if deflation is a serious danger in an economy, as the central bank will engage in expansionary monetary policy, it will change the bank rate in a way that is designed to stimulate or increase aggregate demand. So, of course, that means that it will reduce the bank rate, the rate it charges to commercial banks when they want to borrow money from the central bank. The central bank will reduce this interest rate. And it will hope that the commercial banks will reduce their lending rates that they charge to customers who want to borrow money from them. So this is the logic. When deflation is feared, the bank rate will go down. This is an example of expansionary monetary policy, and the hope is that the commercial banks will reduce their lending rates to their customers. But the question we have to ask ourselves is, how far can the bank rate go in a downward direction? How far down can the bank rate go? Well, obviously, the furthest it can go is 0%. And this effectively means that the central bank is willing to lend money to commercial banks for free. Now, it can't get any cheaper than that. Free is as cheap as anything gets, including borrowing money. So we have a problem because there is clearly a limit to traditional expansionary monetary policy, traditional being controlling the bank rate. We can only change the bank rate down to 0%. It can't go any further down. So it is possible to have a scenario that if we have an economy where output is falling and prices are actually falling, in other words, we have a deflationary economy, the bank rate may go down all the way to 0%, and there still may be no effect on GDP. GDP may still continue to fall and prices may still continue to fall, even though the bank rate is as low as it can possibly be. So this is the worst case scenario for traditional monetary policy, traditional expansionary monetary policy. Once interest rates, or once the bank rate reaches zero, the central bank can't do anything more with the bank rate to stimulate the economy. So it has to try to think of something else. Now, although this is not officially a part of most junior level or low level courses or pre-university courses, that other thing that the central bank can do when traditional expansionary monetary policy has failed is called quantitative easing. If you want to know more about quantitative easing, there are several sources which describe this method of stimulating the economy with monetary policy. This type of monetary policy is very non-traditional. It's not to do with the control of the bank rate directly, and it's not to do with the control of money supply directly. But it is something that is used and has been used following the financial crisis of 2007-2008, when there was a fear of a massive and long-lasting depression in the economy. So the first thing that central banks did was to reduce the bank rate, and when it fell to close to 0%, they had to try something else to stimulate the economy, because even that was not enough, and so they did engage in quantitative easing. So bear in mind that when traditional expansionary monetary policy reaches its limit, there is an additional weapon, although a very rarely used weapon, called quantitative easing, which the central bank can use in order to try to stimulate the economy.